Okay, we've got an interesting midpoint in the markets. Not only are we essentially in the middle of the year, we are going to be digesting earnings. We've digested a lot of interest rate moves, and now we're assessing whether or not this general momentum for stocks can continue. And add another layer to that. How might Canadian stocks fare versus the U.S. market? Because we know the TSX has lagged the S&P so far this year. Let's get some more perspective on all of that. Stu Morrow joining us, Executive Director and Canadian Investment Strategist at Morgan Stanley Wealth Management. Nice to see you.
Nice to see you. Thanks for having me.
Well, let's get right into it. I mean, Canada lagged in the first half. What do you see in the second half?
Yeah, so I think we should talk about the outperformance in the U.S. market and what's been driving that. It's principally multiple expansion. So when we started the year, the S&P 500 was trading about 16 times forward earnings, and it's trading around 19 times today. So that multiple expansion was on the back of additional fiscal stimulus that we saw, the CHIPS and Science Act, the Inflation Reduction Act last year, additional liquidity provided to the U.S. banking system in March and April as well. And then more recently, a shift towards, enthusiasm around artificial intelligence. And, all of those things, John, of course, are beneficiaries to the S&P 500, not the S&P TSX, where we're mostly commodity resource driven. And one of the things that we talked about in our report is this valuation gap has opened up, and it is a quite rare instance. So we looked at the equity risk premium between our two markets and found that the Canadian market is offering about twice the equity risk premium today compared to the U.S. market. So we think that rare instance, which has occurred about 6% of the time since 2000, is an interesting opportunity for investors looking to invest in Canada.
Without a doubt. And it's interesting, some of those themes you talked about in the U.S. are also seen as reasons why we haven't even seen a recession in the U.S. And now people are wondering whether or not we're going to see a notable contraction or not. So if we avoid the worst of it, maybe that helps investors feel a little bit more confident on some of those Canadian sectors as well. Yeah. But yield becomes a big conversation too, right? I mean, yes. When I've heard people highlight the differences between Canada and the U.S. this year, they're also looking at what you're getting from Canadian companies, which last time I checked, they've been pretty dedicated to things like dividends of late.
Twice the level of the S&P 500 actually on the TSX composite. So, and that's the aggregate, of course, from an industry perspective and a sector perspective that differs. But, when we think about sector investing at Morgan Stanley Wealth Management Canada, we like to think about the near term and the longer term. So from a near term perspective, definitely valuations and yields, as you just said, are quite attractive. From a longer term perspective, and we get into this in a recent report that we penned, really around the idea of a U.S. capital spending super cycle, and all of that born out of pre-COVID, accelerated in COVID. So think about reshoring, onshoring, and companies, John, moving from the idea of just-in-time inventory to just-in-case inventory. And we think, given the close ties that we have to the U.S. in terms of our trading relationship, that the Canadian economy and indirectly the stock market in Canada will over time, over a long term, sort of benefit from that stimulus as well.
Yeah, it's interesting. And are we seeing a new geopolitical map? But that's a story for another day. So if you mentioned the makeup of the Canadian market, like tech, yes, it's done well, but it's got a very small weighting. So we've got these big weightings in energy, financials, materials, to a slightly lesser extent, industrials. But these are the kinds of sectors you think could have a reasonable run from here?
We think so. And of course, we like to think both long-term and near-term. So from a near-term perspective, we do think that the valuations on those sectors that you mentioned, which are the key earnings contributors to the TSX, so financials, industrials, materials, and energy, are all trading anywhere between 50 to 60% of long-term valuation averages. So potentially recognizing a lot of downside already in those multiples. Now, earnings revisions keep coming down. We understand that. But we do think if the market is correct in that we're moving to a reflationary trade, that growth is not going to decelerate, but sort of stagnate and grow from here, that those sectors that you mentioned could be beneficiaries.
So I have to ask about oil, because even in the Inflation Reduction Act, part of that is about helping to turbocharge an electric vehicle-filled future.
Yes.
And there are really strong cases that people make on both sides of the oil trade right now. Sometimes makes my head spin.
Yes.
But over the long term, how do you see the energy story playing out?
So it's a good question. So over the long term, there is going to be a transition away from fossil fuels and those sorts of energies. We understand that. But taking a perspective, a Canadian perspective, we know that Canada could supply the world with cleaner fuel. And one of the things that we talk about in the report is this idea of the trading relationships we have with the U.S. and benefiting from that. So supply to the U.S., supply to the world for cleaner Canadian energy. We think that as the world transitions, which will take some time, that Canadian industry will evolve, and then that will also mean evolving of our market cap and evolving of our index as well.
And then on the financial side, we just got a look at the big money center banks in the U.S., how they're performing right now. I think the one thing you keep hearing about some of the Canadian banks is, well, the exposure to the economy, what's going to happen in the housing market. We've already seen these interest rates ripple through the mortgage market. What's your assessment of investing in financials in this country right now?
So financials today trading at discounts to long-term averages, and obviously that's reflective of slowing demand, loan demand environment. So, not a recession per se, but definitely a slowing environment where we see the earnings revisions in the financial sector still ticking down. So we haven't yet seen a slowing in earnings revisions. And when we do, we think that's more of an interesting point where we think that the sector will start to perform and outperform. From a dividend perspective, we do think that the bank stocks are paying healthy dividends and that those dividends are well covered in the event of more of a bear case around the housing market, as you alluded to, where provisions have to start ratcheting up even further.
Okay.